Happy Friday, folks. It's Shayan from Integrity Home Mortgage, back with your rates rundown for July 17th, 2026. So, this has been an interesting week. If you look at just our benchmark numbers, you might be led to believe that nothing really happened, but that's actually not the case at all. In fact, it kind of feels like this has been a week long microcosm of the push pull tensions that have kind of defined mortgage markets for the bulk of the year. So, let's start by taking a look at those benchmarks. 10-year Treasury yields are minimally changed this week at 4.55%, and the 30-year fixed mortgage rate is worse by maybe 2 or 3 basis points, pushing back up to 6.73%. So basically, we opened the week with 30-year mortgage rates hitting their highest level in about a year, which was then canceled out by a strong midweek rally and bringing us all the way back to where we closed markets kind of last Friday. So, why the dramatic swings? Well, really, it's all the things that we've been talking about on and off for the whole year. Escalating tensions with Iran, pessimism fueled by worsening inflation concerns, optimism fueled by those inflation concerns not fully coming through in the actual data, and uncertainty around Fed policy. Each one of these issues kind of flows into the next. So let's start with Iran. Clearly, tensions have worsened over the past couple weeks. Both sides have traded missile strikes. Traffic through the Strait of Hormuz has stalled again, and oil prices have climbed like 20%. This, of course, fed into those increased inflation concerns. Now we're a far cry from the $100+ a barrel area we were for most of April and May, but markets are just a little more sensitive due to the fact that there was an unexpectedly hawkish tone struck by Kevin Warsh in his first Fed meeting just a few weeks ago. This is what was powering the weakness in rates at the very beginning of the week. Ironically, it was actually this very same issue, inflation, that caused the stark midweek reversal. Measures of consumer inflation and wholesale inflation both came in materially better than expected on Tuesday and Wednesday. The consumer price index fell by 0.4%, which is the biggest monthly decline since the beginning of COVID lockdowns. The producer price index also painted a very similar story. So the reality of inflation fell short of the elevated expectations around inflation, which prompted investors to dial back their rate hike expectations for July and allowed rates to recover all their losses and then some. So it's important to note, though, that the majority of the improvements, maybe all the improvements in inflation, were driven by improved energy prices in June as a result of the peace deal, the memorandum of understanding. And that phenomenon is no longer in effect, right? It no longer exists. So there's like a little asterisk around these favorable inflation numbers, and that's why rates have weakened just a little bit heading into the end of the week and are ending up right where we closed them last Friday. Finally, let's talk about Fed policy with inflation signals pointing in multiple directions, geopolitical gyrations, and the new leadership at the Fed. There's heightened uncertainty around Fed policy. Kevin Warsh's testimony to Congress this week highlighted this in fact, when he simultaneously acknowledged that elevated mortgage rates are causing an undue burden on households, while also declaring that the Fed has no tolerance for persistently elevated inflation. So basically, rates are high, and that's bad for consumers, but we might have to make them higher because inflation is also bad for consumers. So stay tuned on what happens there because next week is a light one for data, but there will be no comments out of the Fed officials because the following week is their next rate meeting. So they're on a media blackout. They're almost certain to remain on pause at that meeting. So for the time being, we're going to expect Iran headlines and oil prices to continue to be the main driver of mortgage rates. Further escalation will push rates higher. Renewed diplomatic efforts should see an improvement of rates. That is until the following week when we get more comments out of the Fed and out of Kevin Warsh. That's all I got for you this week, folks. Have a great weekend, and we will see you next time.